wake up. From Jerusalem, Israel, this is From the Midwest to the Middle East, the podcast that explores everything new in U.S. and Israeli economy. Here's your host, Philip Stein.
I'm really pleased to be having this podcast today. First of all,
this episode is brought to you by Philip Stein and Associates, the largest U.S. CPA firm in Israel, providing U.S. tax services to Israelis, Americans, corporations, startups, and anyone else needing them.
I'm very excited today on an interesting topic with a very interesting friend who I will refer to, who is Glenn Yago. So Glenn is a senior fellow and founder of the Financial Innovations Labs at the Milken Institute and senior director of the Milken Innovation Center and Blum Lab for Developing Economies at the Jerusalem Institute. The center and the lab that he oversees in Israel serves as a development finance field school, providing postgraduate fellows training in innovative finance practice to launch high-value tech solutions for global sustainable development. His research contributed to policy and program innovations, fostering the democratization of capital to traditionally undeserved markets to finance ideas for projects by business and social entrepreneurs globally. The National Science Foundation, the Ford Foundation, Google Foundation, Gilbert Foundation, Rothschild Foundation, and the Bill and Melinda Gates Foundation, among others, have supported his research projects. His latest book, with Frank Allen at the Imperial College London School of Business, is an advanced introduction to financial innovation. In addition, Glenn is also a visiting professor and a Dean's Fellow at the Hebrew University of Jerusalem School of Business and the University of California, Berkeley. Welcome, Glenn.
Thank you so much, Phil. Great to be here.
It's always good to see you. And, 2024, we got 1 month behind us, but it just seems like anyone I talk to, no one knows exactly where this year is headed. And I thought a good way to start this series was to talk about the economy, particularly Israel's economy. So I'll go to my first question. Way back when I started in university, the first course they offered, I don't know if it's still true today, was macro as opposed to microeconomics. So I want to ask you a question about the macroeconomics of Israel. We are now in February 2024. 4 years ago, we were on the cusp of pandemic. 1 year ago, we were in the midst of the struggle over judicial reform, with companies threatening to leave Israel. And now we're in the midst of a two-front war. Israel seems to be on a roller coaster that makes economic planning and prediction extremely difficult. And yet I ask you, where are we economically?
Well, I think it's really trying to unravel the uncertainty that we see. And I think, if you just, we focus on the events just of 2024, really the whole first quarter of the 21st century has been quite a rocky road for the global economy. And Israel's always been in a position and remains in a position of being very much a canary in the coal mine of being buffeted. Certainly the types of volatility that we've seen from our own recent and current war were reflected, in March of 2022 when Russia invaded Ukraine. There's so these regional wars are definitely having an effect on the overall global economy, and that is amplified. And I think any of these events, whether it be the pandemic or the recessionary pressures that didn't actually crystallize as bad as everybody thought that they would, in terms of the global recovery after the pandemic, but still were very hard on many of our trading partners. And then behind that, we've got the huge issues around transitions that are going on in the energy sector and dealing with climate risk and all of these other sorts of factors. I have a slide I use in my teaching talking about macroeconomics a lot, is to look at these waves, for the mini wave of the pandemic, the wave of recessionary pressures, and then inflationary pressures last year, and then climate change as being an overall. And then you add to that, in our neighborhood, we have a war. Another assignment we've had recently from one of the ministries was to look at catastrophic risk according to seismic risk that we have on earthquakes. So, I mean, we don't lack challenges here in that. but the fundamentals probably have never been quite as resistant. The thing that you always have to say a quick caveat about, though, is that what this war represented, and I think also in the months preceding it, was the judicial reform, which was having a pressure on credit default swaps or having a pressure on currency exchange rates and other things as well, is that a lot of conceptions, the noise we hear in the markets and sometimes signals in terms of the signal to noise ratio of what we hear from the markets, is that we do have some really serious structural challenges. But on the basis of that, we still got, over $500 billion economy with still running at about $170 billion in foreign exchange reserves on the balance sheet of the state of Israel. So we've been able to afford to strengthen the shekel pressures, and there were a number of other pressures in the currency exchange rates. So a lot of the fundamentals are really there. And even if we're looking at the pressures that'll come to us with the increase of both military spending, it's nothing like what it is on the terms of the proportional level that it was after the Yom Kippur War, or where we were when we had a much more narrow and concentrated economy that was less diversified into the technology sector, which all its problems, it still has enormous growth potential and is driving a lot of that recovery. But so if we go from 57% debt to GDP ratio, we're talking about macro indicators, up to 67 or 68% of debt to GDP, it's a lot. And we have to go back to the capital markets, and we have to be able to engage in that. So what happens? So we're not in any way insulated from those macro pressures. But we still have structural issues that we should talk about in terms of the labor markets, in terms of other markets that work at that level that affect our productivity, which is lagging relative to other OECD countries and has been for a while. But that's amplified here when we're on a war footing as well. So I think there's a lot of fundamentals that we're in a much stronger shape, and there is resilience in the economy, and we can talk about, maybe drill into that a little bit more if you'd like to talk about that as we unravel.
Okay, so maybe just walk us through a few of these slides, which is very interesting. I think particularly, my clientele and many of my friends, Anglo friends in Israel, there seems to, since I've been here, there's always been an obsession with following the dollar shekel, exchange rate. And people sort of reference, they talk about their aliyah, and they can tell you, they may not remember the date they made aliyah, but they can remember what the exchange rate was, dollar shekel. Okay, because maybe that's when they brought their money over or bought their first apartment. So what you're showing here is that there was certainly some volatility, but it seems to have come back.
Yeah, I mean, the shekel, lost about 6% against the dollar since the war started. But if you compare this to the unfortunate other security challenges we've had in defensive shield or protective edge, or the second Intifada, or COVID, or the second Lebanon war, you can see that volatility in the exchange rates and just the data points aren't as important as the actual point, is that we lost 6% against the dollar, and that's totally come back. Part of that was because we spent I think $20 to $30 billion buying back shekels in order to strengthen it against the dollar. So the central bank and really two remarkable, in my opinion, the two remarkable institutions in the country remain to be the Army, the IDF, and the Bank of Israel, in terms of creating a stabilization, which also has a positive effect on the way investors look at the place as well. If you take over the exchange rate and go back to the equity markets, we still have some challenges here that in the wake of the war, the Tel Aviv 34, which is an index number, it tumbled about 12%, and it's come pretty close to clawing all of that back here in the last 2 months, especially after the ground operation.
Yeah, I
to effect.
certainly noticed personally, October was like a disaster. But
October was
November,
bad.
December, it all, at least from my own personal perspective, it all came back plus.
Right, and this relates to the exchange rate issues that you were asking about, because many of the Tel Aviv Stock Exchange 34, about a third of it, of that benchmark index, is listed in New York. So and we have a huge, and remember the from the macro back to macroeconomics, the conversion from savings to investment being such an important factor in what allows for growth to happen. I don't want to in any way underestimate the amount of growth that growth is at risk here as well. But the fact that this is as strong as it is relates to the demand for the shekel too, because Israeli institutions invest also abroad, and they go in and out of overseas securities quite a bit, and they have to sell in order to maintain their portfolio weightings. They'll sell those stocks and have to, and the dollar conversion increases the demand for shekels too. So you have both the central bank and you have the investment rates of institutions affecting that factor. But we can see it pretty clearly if we update this to through the end of December. You can see the recoup of most of the dollar war losses that occurred since the start of the war. But I wouldn't want to be
Glenn,
humble or glib
no,
about
but going back to that chart, go back one to the Israeli stocks, I guess traded in the U.S. So in terms of the investor outlook, when it hit that low point, which shows on your chart like 1600, what is happens? The investment community just realizes there's been a big overreaction. Is that what?
Right. People are looking at fundamentals. They're not,
Right.
just expressing opinion. Markets really reflect expectations always, and they don't reflect necessarily the present, but what people, once we got our legs back in this terrible attack on the country, and that I think put people on more firm footing to say there's no reason to have a panic. That was also reflected in the volatility measures. If looking at the at the credit default swaps level, which also just completely spiked, and this is the volatility measure that's used to basically reflect market sentiment at any.
So can you just give our listeners a just basic tutorial on what credit swaps are?
They're an insurance against a default on a credit in the market. And that if you remember them from the great financial crisis, of course, they were uncovered, but they basically they basically are a reflection of also the volatility in the market, which is another index that is the VTA 35, or it's in the United States too. The fear index is there was this astonishing increase in the cost of insuring debt.
So that seems based
initially.
On this chart, it seems that that is still far from where we were pre, October 6th.
But it's definitely dropping. This only takes you through to the end of November, December. But it's dropped further since then. And if you look at that fear index, it was astonishing. Really, it doubled in value and peaked at around 29 points. And it was at its highest point that it was since the Russian invasion of the Ukraine, which had an effect on our markets. How interconnected all of our lives are and all our markets are is really remarkable. But it's begun to decline, and is settling around 90%. It's about 30% drop from the record high that it had. The judicial reform that you mentioned before was also a factor in creating doubts about the rule of law and the depth, upon which all capital markets depend. And the fear index spiked, but there's no panic-driven rise in margins or spreads in it, so that it's been more stable over that time. But there is a fundamental difference between now and other wars we've had, in the fact that this is looking like it's a longer war. It's not a 3 or 4 month war.
Correct.
And we're not too sure. Nobody can, as you were saying, there's if you like crystal balls, you gotta really like broken glass. And if you or what my econometrics professor told me a long time ago at the University of Wisconsin, so I know you're from the Middle West too. They was that if you're going to make forecasts, make a lot of them.
Well, I one of the not that I am always so follow it so closely, but and again, you may tell me something different, but I have a recollection. This is just a little over a year ago, at the end of 2022. I'd say across the board there was a prediction of recession. Okay, it seems like everybody on any of the economic news programs, the Wall Street Journal, lectures I went to, it was just how much and when and how long, and it didn't happen. So that's
right. And now, the other thing I mention, of course, is the fact of what the S&P 500's done over the last 5-6 months. It's just been
amazing,
enormous, and so that's been that's put the wind to our back on those companies that are listed in the U.S. But again, we'll get to it. I think where there are cracks in the story are there, but this just sort of shows you with the reduction of back to the macro war impact of what the various estimates are from the Bank of Israel to the Milken Institute over at Reichman University or the S&P projects. You can see a much lower rate.
Yes, very.
Or in whatever would be a consensus forecast for the year. So this will be a setback, and it all comes down to the fundamental kind of structural issues that are weaknesses that we had prior to the war. That it's kind of like with the pandemic, just it throws a spotlight on where the cracks are and where there's, as they say, Nikudot l'shipur, where there's points of improvement that really do have to be addressed. And this is,
I think it's actually a question I was going to get to toward the end, but I think in light of that slide you just showed before, I'm going to ask you. In other words, again, this is going way back, and I actually had a visiting professor from Hebrew U at that time when I was in university, and I remember him. I took a course on the economy of Israel, which was certainly a very different economy than what it is today.
Totally different world.
One of my recollections from his lecture was how much the Yom Kippur set the Israeli economy back. In other words, it took years. They were on a certain trajectory, and that trajectory was really knocked off the rails. So I guess my question is, as you say, fundamentally we have a much stronger economy, a much larger economy. So might one expect that the recovery is going to be much shorter in terms of?
I think it certainly could be, because there are a lot of drivers for growth that are fundamental here. I mean, the recovery itself, if we play our cards right, and the politicization of the budget doesn't draw resources away from the economy. I mean, I think both Amir Yaron, Jacob Frankel was a former bank governor, and I think the lessons we learned when Stan Fisher was here, and that are just embedded in the DNA of the Bank of Israel right now, is that we have to pay really special attention to have a growth-oriented budget, not one that is basically subsidizing people not to work, and that has that very strong bias that will or to have expenditures that aren't related to the recovery, because there's a lot of recovery to do. I mean, the country shrunk in terms of what happened in the Gazan envelope, the steps that'll have to be done in order to ensure the recovery of the North and really integrate the regions, which has always been on the agenda of the country. I mean, we're I always hate the use of that word periphery, because you don't have a periphery in a country this small. You can't afford it. It has to be mainstreamed. Right. And that's really where the challenge is. And they've been there for quite a long time. And they need to be systematically addressed. And I think, the National Recovery Administration, Minhelet Tkuma, how that runs out in that region of the country. And then as things focus back on the North as well, and on the marginalized parts of the population that have to be mainstreamed, there's enormous growth potential in this country. That's the remarkable part of it. And this is one of the relationships, and it's just a very simple one, but one of our fellows did this over at the Taub Center down the street from where I'm sitting right now in Jerusalem. And Gilad Brandt, who's been at the Bank of Israel and been also at the Taub Center, you can see where our growth, our population growth rate, demography is very much destiny, and we have a great age structure. I always like to say we have maybe a glib way of saying it, but we have a very young country, really, thank God. And yes. And the age, the dependent population, there should be a demographic bonus from having a young population ending in that would have high productivity and drive our growth.
Right.
Again, we have a first world savings rate, so our age structure resembles what the underdeveloped world looks like in terms of age structure. But we have fundamentally people that know how to read and write and can be literate and can go into the workforce. And we have challenges in our educational system, but still a great university system, a huge amount of investment in research and development. And it comes back to the basics of the macroeconomic fundamentals, that it is R&D and human capital that drives growth. And that's the growth that's at risk right now. And that's what this relationship where you can see that where our population growth is really high, our rate of gross capital formation is actually lower than places like Norway and Ireland and South Korea.
Quite a few countries. That's quite illuminating.
And that's our basic gap that we have to bridge as being really activist investors in the future of the country. And that is very much human capital driven. If you look at the high tech sector, that's been and here you can see the different securities events talking there. That has been a consistent wind to our back, and it was challenged by the real. If you follow the reports from the Startup Nation Central and the Venture Capital Association, we've been hit by a decline of investment in that sector, so that is something that really has to come back.
But it would seem to me, as long as the human capital remains here, that will ultimately attract investment. Okay, because these are I know it from my own practice. These are the successful high-tech entrepreneur usually doesn't go home and just play golf. They usually make another company,
right?
Or they collaborate, with other entities, other countries. They have a track record. So I would hope, again, once everyone gets home from the front and gets back to work, that the capital will come in. Okay.
Well, and also we have a labor force that is on the sidelines that's not participating, which I'll show you in just a, or we can talk about that in a minute. But I also want to say where we are in the tech cycle is that the benefits we've had really since in this century from tech-driven growth is reflects about 10, maybe on a good day 11 or 12% of the workforce. But we have the potential of entering another 10 to 20% of the workforce into that tech sector as it moves from just the infrastructure of information and communication technology to applications in and maybe the Gaza envelope is a good example, because there's a lot of great startups down there, or have been in the agri-tech space. There are in other parts of the country too, but in the Western Negev and in the Southern Negev and in the Arava, I mean, people forget that our highest productivity agricultural sector in the country geographically is the desert. That's not the Jezreel Valley,
I see.
and not Jerusalem, and not the Galilee.
I'll just interject, and I think this was in an early chapter of your life when you were working fields in kibbutz. Okay,
Right.
so maybe it was already about a month and a half ago. I was driving early in the morning to Beit Knesset, and I heard them interviewing that because of the conflict, they were turning off like GPS on the Golan. Okay, so
Right.
I guess, and it turned out that the young generation on kibbutz that I'm familiar with, kibbutz Mevo Chama.
Oh, sure, that's where I was there.
Right, that's why I'm bringing it up. That none of the young people knew how to sort of plow the fields without GPS. In other words, the tractors and they had to go back to guys my age, a little older, and get them to show them how to plow a field without a GPS, which I just thought was amazing. That yes, we're very high tech when it comes to agriculture and food tech, but here something basic, it was sort of a basic skill had been lost from technology.
Right. Well, there was a lot of Back to the Future in the last 128 days of this war. I don't know if I shared this with you, but Steph, Achim Leneshek became Achim Lemeshek. Brothers in arms became brothers in farms. So we joined up we were trying to get 1,000 volunteers every week down into the Gazan envelope on the harvest. We were averaging between 250 to 350 volunteers, but it was really quite a relief, and to participate in going back and picking tomatoes and pomelos, you name it, down in the south again, right to my roots. But going back to it, you look at the Milken Institute for an example. Just as the R&D, and there's an R&D center down in Yotvata, and there's one up at Kibbutz Mordechai. Those R&D centers represent enormous unrealized potential in terms of the application of technology into seed and soil sciences and applications of IT. And I mean, 70% of our, always have said, we don't sell tomatoes or oranges anymore. We sell tomato seeds and orange seeds. 70% of the tomatoes in Europe are Israeli seed technology. So there's and you've got a big food security issue as you move into climate change, and arable parts and growing seasons have changed. So the applications of science and technology in areas that are traditionally
actually that was something
high tech is enormous.
I wanted to address when I was young. The symbol of Israel's economy was the oranges. Okay, that was the orange exports. I'd say for my grandchildren, it's high tech. And in light of this human capital, I'm reading a lot lately about layoffs in high tech. There's certainly been a decline in venture capital investment, negligible amount of M&As and IPOs. You think it's just a blip, or is the golden age of Startup Nation behind us?
No, I think it's the I mean, the phrase that we use a lot, it's you can't keep starting up all the time. You have to scale up. And so now, as we move to being a scale-up nation and have
Interesting.
partnerships, and that's why really, if things, really what was the target here wasn't just the Gazan envelope. I think that everybody knows this by now. We were to have had hosted the next set of meetings for the Negev summit, which was all of the Abraham Accord countries that were seeking to normalize with us. That was supposed to be October 10th to 12th, and now, I mean, read about it in the paper. No state secrets here. The Saudis were going to sign an agreement, or come into that process on October the 13th. So the target here wasn't just us, though we were clearly had the bullseye on our back, but it was really a vision of what a regional integration could actually mean for our growth rates, which would have been is and still remains to be enormous. We have in trade in North Africa and in the Middle East. I mean, the benefits of what happened with the United Arab Emirates and its investment into the country would just be scaled enormously as more and more participants came into that. So that's what the Iranians and everybody is shooting at. I mean, they're shooting at us because we're in the way, but they're shooting at some sort of notion of normalcy. I'm not too sure if normalization is the right word, but normalcy in terms of increasing interregional trade and commerce and those factors that could really drive the economy to new heights and will.
Glenn, I'm gonna these slides covered so many of my questions, but I'm gonna put you on the spot for two last questions. One is, for many of my listeners, there are two things I'd say they check every day: the weather and the exchange rate. Okay.
Right.
What's your crystal ball for the shekel in 2024?
Well, that's again gets me to have a lot of humility about people that do forecasts, which I really don't. I do a lot of, but I think the factors that I mentioned would suggest that there's not going that there's everything. Of course, things can unravel pretty quickly. But
I think your comment about the stability and the talent and the vision of the Bank of Israel, means that we're probably going to have pretty much, they're not going to let it get out of hand in terms of.
Yeah, I think that is what the only thing that can get out of hand is the Ministry of Finance, but the Bank of Israel has a steady hand on the wheel there. But you can't do everything just with monetary and fiscal policy. We're fortunate to have had Jacob Frankel, Stan Fischer, Karnit Flug, and Amir Yaron at that helm, and should be very grateful that he signed up for another 5 years.
So my last question, I'm going to go back to, if you recall, my Econ 101 book was by Samuelson. It was, I don't know what edition it was. I don't know if that is still exists, if they're still using that textbook, but it was an iconic textbook at the time. One of the first lessons was the guns and butter. Okay. And I guess my last question is, how can Israel continue to fund a war and yet prevent the budget from getting out of control?
Well, again, there's always that danger, but again, if you look at what military expenditures are as a percentage of GDP, they're a small fraction of what they were at the time of the Yom Kippur War. And the fact that we have peace agreements, I mean, we have Egypt advocating for us in terms of trying to get hostages restored, or we don't have fronts in Jordan. So all of those factors really do reduce the amount, and plus the technology of war has changed quite a bit. Although this is still an asymmetric war, there is with a return to deterrence. Those things I think can be managed and controlled So I don't think it would get out of hand, in
Okay,
terms
good.
of
That's
that
good
amount.
news.
Plus,
So we're in,
as long as
yeah, we're
we
ending on a
continue.
good note, and it should be an interesting year. And God willing, this conflict will end sooner. The hostages will come home soon, and maybe next year we'll talk about how amazing Israel recovered from all of this. And
Right. As long as we approach it with some humility of looking at these data points,
right.
and that it's not all in our hands.
All right, I can't
Okay.
thank you enough. And if
Thank you.
any people want to hear more about your work or the Innovation Lab, where might they go to?
Oh, they should go to www.milkeninnovationcenter.org. That's www.milkeninnovationcenter.org, and you'll see we basically run a field school to do innovative finance and all these subjects we've been talking about, and also especially not only here in Israel, but working with our new trading partners in the developing economies.
Terrific. Glenn, I thank you enough. It was fascinating, and something I think we're all, it's on everyone's mind. There's a lot of things on our mind these days, but this is certainly one of them. And thanks for sharing your, great work, and keep doing it. Okay.
Thanks.
And
Look forward to seeing you again soon.
I'll meet you next time in the tomato fields, Okay. Take care.
I hope you enjoyed our podcast. Feel free to visit us at www.pstein.com or look for Philip Stein and Associates on Facebook and LinkedIn.